Hi everyone, and welcome to this week's webinar. Today we're going to be talking about structuring your business for success, and we are joined by none other than Mr. Mark Stokes from Equa Academy, who is going to be the perfect partner today to hopefully talk us through how we're going to structure that business, not only from a sort of tax efficiency point of view, but also from a funding point of view as well. And I know we get lots of questions around this, and I think Mark is hopefully best placed to give us some ideas around how we should think about structuring ourselves and really setting ourselves up for the sort of longer term. Because I know that's what we're all here for. You know, we don't want to just do that one-off deal. We're all here to try and sort of keep it going throughout. And I think Mark's hopefully best placed for that. Just before I introduce you, Mark, one quick thing for everyone's benefit: the session will be recorded. I know we tend to get lots of questions asking about that. It will be recorded, and not only that, do ask your questions throughout. So Mark's going to run through a load of bits around structuring your business and how to think about all of that side of things, but I'll hopefully keep sort of feeding your questions into Mark as we go along. But if not, and it's better to say them all at the end, we'll definitely have lots of time to run through all of those at the end. I'll make sure everyone's questions get answered. And there'll be a little survey at the end. It'd be really appreciated if you could just fill in. I think there's 2 or 3 questions, just generally, you know, what did you like? What did you not like? So hopefully we can learn and keep improving the webinars that we keep rolling out. And so, yes, without sort of further ado, I can introduce you to Mark Stokes. He's a co-founder of Equa Academy, but also has a long history. I think you've got a slide talking about yourself, so I won't give too much away. I'll leave you to introduce yourself, but welcome, Mark.
Thank you very much, Andrew. Really appreciate the invite to come on the Nimbus Maps webinar yet again. Really appreciate it.
Yeah. Well, to be honest, we've sort of you know, we've been down to your events and things like that as well, and you know, I think hopefully the content you've been providing there, I think it's going to be fantastic for today's session. But I suppose just to sort of break the ice a little bit, you know, what made you sort of leave your successful sort of corporate career, as it were, and sort of move into property and the Equa Academy and all of that kind of side of things?
Yeah, well, I did my degree back in 88 to 92 at Polytechnics when there was such a thing. And that was in construction, and for 25 years that was my life in the construction and infrastructure world. Spent most of my time on planes working around 33 countries. But you know, Andrew, you know, you reflect on that, and it was an absolute privilege to see the world. I was very well remunerated, but at the age of 44 in 2014, you know, I was running 7 different companies for a PLC. I was a non-exec director in other companies as well. And I had 4 children, and I knew I wasn't going to have any more children. I knew if I kept up that same pace, I'd have more businesses to look after. And I had to make a judgment call, to be honest, as what was the most important for me in my life. And it wasn't a very difficult decision, but it did take a while to make, and probably took me a year to exit. So 2015 was when I stepped out of corporate life and started to create a multi-generational conglomerate of businesses and investment interests.
Fantastic. And I think you've got a few slides on that as well, which we'll sort of see as part of as we go along. So I guess without further ado, then we shall stop sharing my screen, and then you can share yours. And like I said, if you've got any questions as Mark's going through, feed them through. I'll try and keep feeding them into Mark. You know, you can concentrate on your slides, and yeah, over to you, Mark.
Thank you very much. And once again, it's always a privilege. Life's about collaboration, and the collaboration and the deep relationships that Equa Academy have with Nimbus Maps is really appreciated. So let me just get these slides up. Just bear with me.
No problem. And like I said, you both got the chat function and the Q&A function for everyone else's benefit. Feel free to post anything in there, and we'll hopefully keep questions going through to Mark or myself. If there's anything Nimbus related or anything property related that I can answer, I'm more than happy to try and answer those as well.
Brilliant. So I think that slight technical glitch, you can see my slides okay there, Andrew?
No, unfortunately, we can't. We can just see you, Mark. It might just be a case of resharing the right screen, maybe.
Okay, let's try again.
So let's see. It looks like you're, the presenter one. We can see the one with all the next slides and everything as well. There we go. That looks like the one.
How's that?
Yeah, spot on.
Brilliant. Right, well, sorry about that. So, yes, structuring your business for success, hugely important. And it's something that I've spent a lot of time over my years involved in restructuring, a business turnaround specialist. And I've seen the best that corporate life and best practice can hold. And I've also seen some of the challenges, and it's a pleasure to be able to share some of those foibles, some of those interesting aspects. But what I really want to focus on here as well is not just structuring your business, but it's also understanding what your strategy and your business structure means to the most important person in this process, and that's you, the founder, the stimulator of the idea. You are the catalyst for creating shared value. So just a little bit of those property developers and investors. That's our podcast, and also our Facebook and LinkedIn group. So Nigel and I are pretty active on there. So let's start with the forms of wealth. So often when we use the word wealth, we use it in a financial context. And true, yes, that is just one of a number of forms of wealth. I like to look at things in a number of ways. Your health is probably your number one form of wealth. If you haven't got your health, you haven't got anything. Secondly, of course, we've got our financial wealth. Thirdly, wealth of time, that freedom of choice. And Andrew, you alluded to that earlier on. Why did I want to make that change for me and my family? Well, it was to preserve my time, and it was to have that freedom of choice. I might have been CEO or MD or chairman of companies, but ultimately I had a master in the business, the ultimate board that I had to answer to.
Yeah.
Hugely important. Family, friends, relationships. Again, many of those took a back seat for me for 20, 25 years, and I was no longer prepared to do that.
Say it like the two go hand in hand, don't they? That time and family.
They absolutely do. And then my personal growth, my personal aspirations. What do I personally want to achieve with my wife of 20 odd years? That was hugely important for me to understand as well. So I think it's always important to dial this down to some metrics, to have some clearly defined goals. Now, I'm a detailed person. That'll probably come out in this presentation. I've got a lot of slides to get through. I want to really, honor the code that is Nimbus. It's about detail. It's about reliability of information and data. So what a great place to start of calibrating your goals and setting yourself clear financial targets. I also do those in personal relationships, health as well. So in my world, there are 7 different levels of personal wealth: dependent, solvent, stable, secure, independent, abundant, and opulent. And I've put a gauge on this. I put it in 2 categories, one being cash flow, often spoken about, should be spoken about more often. I've seen more businesses go under through lack of cash flow than anything else, and more people set in misery without cash flow. But we need to elevate the performance of cash flow wherever you are, whether that's in a dependent or solvent state, or even an independent or abundant. The more cash flow you have, the more options you have. But what doesn't get mentioned often enough is net worth, and putting a figure on the growth and acceleration of your net worth as well. There comes a point when the cash flow that you're creating, it becomes very tax inefficient to take that. You only need so much to live on. And then it's how do you invest and capitalize on that cash flow and create that into typically assets and grow your net worth significantly. So we have a separate set and scale of targets on net worth. And you might want to screenshot that, but you can identify where you are at the moment, the now column here, and then where you're going to be in years 1, 2, 3, 4, and 5 and beyond. That sets the gauge of your track. That sets the aspirations and gives you the ability then to start to put a plan together that will enable you to hit those targets. And there are, in my experience, and I've been in business for the best part of 31 years now, it boils down to 7 steps. I'm not going to say they're simple steps, that would be inaccurate, but there are 7 key steps to a route to success, whether that be in business terms, in personal terms, or indeed in property terms. And many people on this webinar this evening will be involved in property, I'm sure. So the first area is mindset, having a real clarity on mindset, and that starts with your vision even before you get to the next section, which is clarity in your strategy. We need to be leading from the head, not from the heart. Emotion can get us into trouble, and we have knee-jerk reactions. So clarity in strategic thinking. Creating that cash flow. We need that underlying cash flow. That creates the stability and the security that enables us to lift off into the stratosphere, taking those next important steps in our wealth creation. Leverage. There are over a dozen layers of leverage, different types of leverage, and it's not just time and money. There's an inordinate amount of leverage, and maybe that would be a subject for another webinar in due course, because many are overlooked and they're hugely important as you start to scale your business aspirations. Assets. I'll talk about assets shortly. Assets are the underlying catalyst for wealth. Then, of course, we're always looking at protecting that wealth. No point in creating the wealth if we don't protect it. And I'm talking about protecting that wealth long-term, multi-generational, detailed trust structures, looking at IHT. I have 4 children. My children are 11, 15, 19, and 21. So it's very important for me to understand what will happen, what those children are looking at, what they're trying to achieve, and calibrate that model and work with them as I create my wealth and gradually hand that wealth over in a tax efficient way. And of course then scale. How do we create that scale? We don't want to do it once. And having a system, what is your operating model? What is your modus operandi? I can tell you, if you're a market trader and you're selling apples one week, toothbrushes the next, and dish mops the next, you're not going to learn a great deal. But if you've got a model that you fine-tune, every developer, we've done over £100 million worth of developments, new land build and commercial to residential. And I know that the third development we did was better than the second. The sixth was better than the fifth. And we just keep, it's that evolution. We need to plow that into our operating model to create the scale to improve. And I mentioned 8 types of assets, and here they are. Business, creating business assets, creating property assets, pensions, or in my case, my passion is for SaaS pensions. Intellectual property, I've written 5 books, and we have the Equa IDA development analysis system. So there's 6 layers of intellectual property as an example, and we're creating others as we speak. Stocks, shares, trackers, less of an influence for us, but that was a very big part of my corporate career, unbeknown to me, because I just put my money in a pension, and I was one of those people who got my pension statement once a year, dropped on the doormat, and I'm thinking, well, that's not very good. Hopefully it'll be better next year. That was my pension management strategy for 20 odd years. I now know very different. Joint ventures. We mentioned collaboration right at the top of the hour. As soon as we started the really important collaboration and joint venture we do between Nimbus Maps and Equa Academy, hugely important. You can go quite quickly on your own, but you can go a long way together with others. But that's that connection of values that's important. So I put joint ventures as a very key asset. Increasingly, we've got digital assets. You know, we've got Bored Ape, we've got NFTs, we've got cryptocurrency. It's an emerging space. And with the volatility that's going on in today's market, a very interesting space for some. Again, I'm not a big risk taker, but certainly I'll keep my eye on that, and interested to hear from people who are doing that.
I was going to say it seems very risky right now, but certainly compared to property and everything else. But like I say, it's still an asset, isn't it? I guess. It
is, and I guess it's, you know, in the true definition of an asset, has it been proven yet to be an asset? Evidential, I'm still waiting for the results, but I think it's important we see that emerging area as a potential asset class. And then finally, I'm going to put the power of a community. Now, whether your community is 10 people, 100 people, or 100,000 people strong, the value of having a community in terms of idea generation, collaboration, can lead to joint ventures, idea sparking. We run a mastermind. Again, that's part of a community. But the power of a community is incredible. A community can create ideas, it can shift momentum, it can evolve and fine tune, it can be monetized. There are so many different areas there. So that's a really important one, and it has been for us for over 20 years.
I would agree.
Yeah, I mean, Nimbus, you've got a great, leading edge community there, and you engage with them on a very regular basis. I'm pleased to have been part of that.
No, I think it just becomes more and more important now. I think I think in today's world, it's, people rely on what other people think and everything else, and not just what's been shoved in their face through a marketing campaign or something. So I think across all aspects of life, not only property and everything else, but I think that's a key one to put on there, really.
Yeah. But I want to take you back to the most important part, or the most important person in any business concept. And that starts with the founder. It starts with you. What are you looking to achieve? Okay, it's what is your economic equation? What are you looking to achieve? It might be financial. There might be your vision, your personal objectives. I mean, I was in Equa Academy for the Stokes and the Green family, which is our collaboration, our shareholding. I've been a joint venture partner with Nigel for 24 years now. We've been in various forms of business and mentoring and non-exec directorships for nearly a quarter of a century together. It stands the test of time. And ours is we earn, we protect, we invest. We earn, protect, invest. not overly complicated, and I'll show you some examples of what our model is, but it's creating this circular economy. And we're always starting with the end in mind. And if we get the calibration of risk and opportunity right, we'll create the equity, we'll make our money on the way into a deal, and we'll liberate that into cash during the course of the development, as an example, or business investment. But we're creating the equity wedge right from day one. So what is your Equa economic equation? That's really important. And from then you can start to create a business. I've seen people start a development and they've structured their senior debt and their private investor capital in a way where they're creating a profit share. They've given no consideration or little consideration to how they structure that so that they get a return. We can do a £10 million GDV development and make cash flow quicker than doing an HMO. If you know how these things are possible, and it's absolutely ethical, absolutely transparent with the bank, with private investors, and what we're not doing is taking profit up front either. It's a small contribution to cost. So the language needs to be very clear. So it's setting your stall out in a manner that will work to fulfill your needs whilst honouring all your commitments to all the other stakeholders. Mm. And I think that's the point. Wealth creation doesn't have to be complex. There's a lot of people who will make it sound overly simplistic, and they'll also make it sound overly complex. Hopefully we're going to take the middle ground here. I don't believe in the 5 simple steps to creating £1 million in a fortnight. I really don't. And equally, I think that lures people into a false sense of security when core bank grade due diligence is incredibly important in every investment you do. But these are the type of wealth creation areas, we'll call it deciphers. D is for dividends. What are you looking to get out of the business? Well, you could get out in a tax efficient way dividends. Well, if you're looking at dividends, dividends aren't going to come to directors. Dividends come to shareholders. So you need to look at what the shareholding structure is of your business right from day one, year one. Nigel has 4 kids, I have 4 kids and our wives. So there's 2 families of 6. So we have 12 shareholders in our ultimate holding company for that very reason. So we can pay dividends depending on the age group of kids. And it's about driving down our tax burden. Creating equity. We want to create that equity growth. That's how we're going to get that increase in net worth. We want to put tea on the table ourselves and create cash flow. And that's how we're going to fund the growth of the business as well, through the free cash flow in the business. We want to create the income. So generally we're on fairly tax efficient salaries, taking pretty minimal salaries and a lot larger dividends. Of course, we have our SAS, small self-administered pension scheme. I'll come to that in a while. And we can make very, very substantial contributions. Many will know that the limit is up to £40,000 a year into your pension. Well, a SAS is extremely unique in this regard, in that you can put up to £500,000 a year into your SAS. It's called an unallocated fund. So the more you know, the more options you have.
I'm guessing that's not tax-free then, I guess, at that point, or?
Yep, tax-free. It's pension contribution. And it's unallocated across the members of the SAS. So your SAS has to have more than 1 member. Between 1 and 11 is the number of members of a SAS. So if you're a single member trust, then you can't do an unallocated fund. Mm-hmm. You need 2 or more. Creating hedge. That might be storing wealth in gold or something like that. Might be creating a cash reserve as well, that hedging the market as well. And we do this on diversification of our strategies, our individual and company business interests and investments. So hedging the markets. If you imagine you're a developer and you buy, develop, sell, well, you're going to have peaks and troughs in the market. When the market's on a down, then generally rentals are going to rise. So we hold stock and we sell stock as well. I've already mentioned earnings, royalties through intellectual property rights as well, creating the asset once and then letting the asset create value for us every day with a very light touch, a very high return on time employed. And then there's speculation as well. We've recently, about 2 years ago, we invested in an IT company that makes software for virtual reality headsets. A lot of our fellow shareholders are Premiership footballers, Thierry Henry and various others. So really fascinating drive into that market. But that's a long-term speculation out with probably our normal investment portfolio. So the question I always ask, and it's the same question Sir Frank Williams of Williams Motorsport asked him, God rest his soul, he left us earlier this year. Does it make your car go faster? Every time Sir Frank was given a requisition order, a purchase order, an invoice, a check to write, before I sign this, does this make my car go faster? Now, there was a guy who knew that core strategy and targets of his business to make sure not only did that car go faster around the track than anybody else, but it also got to the end of the whole race faster than anybody else as well. So the strategy selection process, this might be helpful. Again, you might want to take a screenshot or a photo of this. We use this to select. I work with a lot of our mentees to help them gain that clarity on exactly what strategy they're going to pursue. And strategic decisions should not be made with the heart. They should be made with the head. But they also must be something that you enjoy doing as well, in my opinion. That's not to say every day is going to be enjoyable. So we've got a few examples at the top here. We've got a job, PAYE, employment. Could be property development, buy-to-let, book royalties. SaaS, 3PU is third-party unconnected loan. It could be investing in a business. You choose. You can alter that top line. And then against each one, we would look at what is the annuity returns or the monthly returns on that investment or that strategy. What do we expect that to be? How much time is it going to take? And therefore, we can put an hourly, daily, or monthly rate on that time. Can we leverage it? Again, can we reduce our time and actually bring in people who are better at doing certain tasks and functions and expertise than we ever will be? Enjoyment. Do we enjoy it? Key factor. It's hard to put a scale on that. I'll just put a scale of 1 to 10 on it if I were you, and just that probably is a bit more of an emotionally led one. Do I have the right skills? If not, are the skills readily available? Will it create me one-off income or recurring income? Really important one. You can imagine book royalties, it's recurring income. Whereas a property development, if you're buy, develop and sell, it's just going to be one-off, which might be exactly what you want at that time. But later in life, later as your business grows, you might be inclined to hold more of that, more of those as fixed assets rather than hold them as stock to sell. Are you growing a business or an interest that can be sold? I'm thinking business here. Are you getting out of the way yourself? Building a team that you can hand the baton over to enable you as the primary shareholder to sell that business in due course. Really important there. Don't become just that linchpin in your business because nobody will buy it. And I know that from personal experience because I used to run mergers and acquisitions in our PLC. And the first thing we would look for is we would look at what is that exit strategy, what is the management team, and who's selling the business, and have they got the black book to the business?
I suppose the key thing with this, Mark, isn't it, is that you could change this for whatever means matters to you, isn't it? These are, I guess, fundamentally suggestions, and certainly along the top, I guess you could put any of their strategies that they might be interested in and start working it through like that. It's that sort of, the process is the key thing about applying a bit of structure to it, isn't it?
It is absolutely right. It is. And across multiple dimensions as well. We've got financial return, we've got time, we've got lifestyle decisions there. We've got the projection of time, is it 1, 3, 5 years, what the exit strategy is, and risk as well. What type of risk? If you're absolutely paranoid about risk and you don't want to sign personal guarantees and things like that, then maybe you'd look at property development in a very different way and look at how could you fund that maybe at a smaller level using your own SAS pension, for instance, where you wouldn't need any external bank finance. So there's always different ways to look at things. And if you haven't done already, we ensure that every one of our mentees and masterminders have a personal wealth dashboard. It's the 2-minute test. If I ask any question of any information that you've got, it could be your BT bill, utilities, car MOT date, insurance, your assets and liabilities, your experience statement, any of these elements that to do with your net worth and your cash flow and your interests, you should be able to get to it in 2 minutes. And we have a spreadsheet. It's got several dozen tabs to it. That'll include property, our expenses, directors' loan account, list of all their company directorships and shareholdings. All these things are there on one spreadsheet. Yes, it's backed up. Yes, it's password protected. But I can tell you, the weight of the world, that millstone comes off your shoulders and you really feel in control and you embrace what you have when you've got it all in one area. And you can link the spreadsheets, you can start to look at data, look at evidence, look at trends. Hugely important. And people do this in business, but they don't do it for their personal circumstances. And I can't understand why. So this is one of the areas that we help people significantly to be able to take control and make educated, well thought out, eyes wide open decisions rather than leading with the emotion of, I want to do HMOs or SA or property development. And I'll give you an example of how that would come to fruition shortly. But look, just very quickly about me, I've worked in 30 odd countries for 30 years. I've done about 3.5 million square feet of commercial property deployment over the years, worked in M&A, troubleshooting, business leadership, been involved in a lot. And there's some of the examples of some of the finished products. I've worked on a lock and dam in the middle of Mississippi and they freezing my bits off in mid-January, through to running Asia-wide, pan-European data center and fiber optic networks to very complex engineering and new build structures. And in 2015, when I left corporate life, I used that business investing, funding and structuring experience, and I am an engineer and so is Nigel, my business partner, to create a portfolio of assets, some of which we hold, some of which we've developed and sold. But there's around about 100 million there of developments, over 300 apartments, and we've acquired about 18 or 19 commercial properties as well, ranging from a few 100,000 in value to, I think, 8 million was the largest commercial property that we acquired. So new build offices, new build commercial, new build houses, new build apartments, and a substantial amount of commercial to residential conversions. And we hold those in LLPs, limited companies, SAS and trust structures. So this is what we've ended up with, a substantial amount of IP. We make strategic investments in businesses. We do new build and commercial to residential developments. We've acquired commercial units as well. We've got a rake of HMOs, and we've got a lot of buy-to-lets, which we actually really enjoy. And buy-to-lets there is the foundation, hence it's at the bottom there. Now, what we do with buy-to-lets is we don't often buy buy-to-lets, we create buy-to-lets. So our latest development, Ironbridge in West London, Ironbridge House, that's 57 units. It's commercial to residential. Well, it's actually part commercial to residential and part new build. About 40 of those apartments are new build. And we're holding the vast majority of those, which is never easy, but that's our strategy to hold them. So that's an example where we haven't gone out and bought 57 buy-to-lets. We've created them, we've created the equity wedge, and we're creating innovative financial structures to hold them. So I'd summarize myself in 6 areas, really. I'm an investor, I'm a business owner, SaaS trustee, a developer, a business mentor, and I'm a dad of 4 kids. This is an image from the McLaren Technology Centre in Woking. I was very fortunate. A good friend of mine invited me along for a guided tour a couple of months ago. And part of that, we can see there through the amazing innovative building that it is. You can see the life story of McLaren since 1960s and the different cars. Ayrton Senna's cars are there, just incredible. And it's a reminder of evolution. You have to start with version 1, not procrastinating, making a start. And look, version 3 is definitely going to be better than version 1 if you do it right. You give you that fast feedback loops. So just make a start and graduate towards that, but always dwell on what the end might look like. You'll never know what the end looks like. You'll have a pretty good idea, and it will change, and it should change and evolve because it will grow with you. But start with the end in mind. Create a structure that you can grow into, not something that is narrow gauge and you're soon going to burst out at the seams. But make it tax efficient and make it relevant to you personally. Just a quick slide there on how we support people, mentorship, masterminds. We do a 1-day introduction workshop. The next one's in Nottingham on the 30th of June. And we've got really exciting Equa Hub coming out. That's more on that at the end of June. So really looking forward to, that's a subscription model there. And putting a lot of energy in that at the moment. So knowing your economic equation, some of you may have seen this before, but I'm going to repeat it because it's so important. This is our economic equation. And when I said earlier on, it doesn't have to be complex. I mean that, it really doesn't. So the detail might be, have layers behind it, but it starts with that first asset. And then our asset creation starts with number 1, structure. What is the right structure? Then we're going to be looking at how that asset creates cash flow. And then we're going to consider the tax efficiency. And at that point, we're going to be making probably substantial contributions into our SaaS so that we can alleviate any tax burden. And we can do that through pension contributions. We have a number of trustees in our SaaS, and we've got a number of employees and shareholders in our business. So we can make lots of £40,000 contributions each year. And we can also do the general unallocated fund as well. Now, the SaaS pot, we can split that into 2. One half, this is our strategy. There's no rights and wrongs here. Yours might be very different, but we do commercial property and occasionally some third-party loans. And then with the other half, we reserve that for a loan back or multiple loan backs. Now, with the loan back, we loan that back to one of our sponsoring companies, which creates the tax efficiency number 3, and it drives the lowest cost of capital. We want that weighted average cost of capital, that WACC rate. We want to drive that WACC rate down through the floor and get that low cost of capital. If we could do that, that becomes the accelerant, and we can scale the business outbid other offers, create greater volume through, and put that into, again, a very similar structure. And then we'll go on to the second, the third, the fourth asset. What I've showed you there is that circular economy, keeping everything in-house as far as we possibly can, retaining the wealth and creating minimal leakage. And I mentioned buy-to-lets earlier on. We love them, absolutely love them. 1-bed apartments, 3-bed semis. The 3-bed semis are just going gangbusters at the moment with the market. They're not sexy, but we don't want sexy. Sexy is like fashion. We want something that's classy. And I can't see the UK ever not liking 3-bed semi-detached houses. And
Indeed.
they are staple stock, aren't they, Andrew?
Yeah, absolutely. And like I say, that, it's the same whether you're looking to sell or whether you're looking to rent. Ultimately, there's always going to be a market there for those. I think it's quite interesting. You'd always say that for flats, starter homes, all that kind of stuff. But certainly with COVID, I think there has been that sort of move away, and a bit more difficult to get funding, isn't it, on certainly 1-bed flats and 2-bed flats. Certainly there's no outdoor space and all that kind of side of things. So you're right. It's looking at where is that sort of non-sexy bits of the industry, isn't it?
That's right. Absolutely. There's some of the books. There's 5 books there, and the IP that surrounds them. You can see 3 of those have a common theme of SaaS around them. And these are the product of a 35-year itch I wanted to scratch. I didn't probably realize it in 2014, but I'd always wanted to write a book. I'd always been brought up reading books and that smell of a fresh book. For 25, 30 years, I was too busy doing other stuff. And, it allowed me my soul to breathe, if you like, and allowed me to do some of the stuff I really wanted to do. And that's one of my personal projects. We became SaaS trustees, and what better way to become the best SaaS trustee that I could be was, I'll channel that learning into a book, because if it's been valuable to me, learning, maybe there's a few other people out there would also like it, that knowledge, and just illuminate the pathway for others to find their way. I can't set somebody up with a SaaS, no interest in doing that. It's not my business model. But I don't want people in 25 years. Yeah, I don't want people in 25 years' time thinking, I wish I'd asked Mark about a SaaS all that time ago.
Now people can.
Exactly. So for those that don't know, a SaaS, small self-administered pension scheme, 1 to 11 trustees, transfer your pensions across. Not everybody can. There are, there's certain pensions that are protected. There's a defined contribution, defined benefit scheme. I'm not an advisor. I'm not an expert. Don't even want to be an expert in this area. And this is where I leverage with having, a great corporate trustee who helps me out. I don't want to do the legal work for a development, so I get a lawyer in. I get a great corporate trustee to help me with pensions and SaaS work. But what it does enable is, I call it the caliber model. Allows us to collaborate with ourselves as trustees and directors through loan backs. We can acquire property, commercial property. We can create loans. We can invest in businesses. We can borrow money. It resonates. A pension didn't really resonate with me for 20 years. It was something I just did. It came out in my PAYE pay packet. But now I can take my kids and go and have a cup of tea in a cafe and tell them that we own the building. And that's a pension to them. So it starts to get a very real context. And that's where the education comes in, not just education for me. I've grown light years in 7 years since I've had a SaaS. Equally, the children, my 11-year-old doesn't really know what a SaaS is, but she knows that I've written books on it, but she knows more about a SaaS than I did when I was 11, let's put it that way.
Indeed.
Which wouldn't have been difficult. So, one of the things we did, I spent 25 years putting contributions into my pension, and I grew it. We then put the pension into the SAS. We did a single deal, and in 24 months, we doubled the size of my pension that had taken me 24 years to grow. That's contributions and interest. So in 24 months, we did what had taken 24 years. And that's because we paid attention to it. We put it on the radar and said, right, that's on the target. We're going to do something with that. And we did. Rinse and repeat, rinse and repeat, rinse and repeat. And imagine the scale that you can grow that. You've got to be careful of lifetime allowances and all the rest of it. But look, if you are out of all the tax efficiency measures, there's nothing wrong with paying tax, is there? So
I suppose if you get to that point where you are out of tax efficiency measures, then I guess, paying a little bit of tax probably isn't too much of a hardship. But and I suppose the key thing with that is, I guess you're almost, like you say, using that self-funding, you're getting the, whatever return you would have got on the, the finance. That's obviously going back into effectively into your pension again, isn't it? And obviously you get all the development returns as well. So you're getting that sort of double bubble, as it were.
Exactly. And we've also, we've created separation here. We've split the asset. We've moved some of the asset into other parts, into a limited company, because we're conscious of lifetime allowance and tax breaks and, commercial property and various things that we can do. So again, really important. And they're just some of the other areas that we help inspire. Also fairly contrarian as well. I challenge tradition. I challenge it hard. I think understanding SAS in 2014 and getting ours in 2015 really taught me a lesson that it's very easy to be asleep on watch. And I vowed that I would challenge and probe every mortal thing that we do. And this building here is Zurich House. We acquired Zurich House and we've now completed it, actually. It was a permitted development for 44 commercial to residential apartments. And we then went in for full planning 3 years ago and put another floor on it. But this was a drugs den. And in doing the conversion, we can give ourselves the happy, clappy high five of converting it to wonderful apartments. But what have we done for the societal issues, the overnight sleeping, the habitual drug taking and homelessness? And for most developers, they just totally ignore that, kick the can down the road, somebody else will sort that out. And I have to be honest, Andrew, we're not experts in homelessness, but we decided to make a social impact enterprise. And we created a business called Cornerstone Place. And we invest in this business and we sit on the board of it as shareholders and directors. And the target is to help alleviate street homelessness by 2030. And whilst we can't solve the problem of maybe habitual drug taking and homelessness in Crawley, where Zurich House is, the building I've just shown you, what we can do in this particular example is create over 10 years a total of nearly 4.2 million homeless bed nights. That's 4.2 million times a person has a safe roof over their head with warmth and security. And that, the average number of apartments and rooms that we're aiming at and doing is about 1,100, 1,200. And if we do that, we'll achieve 32 million in taxpayer savings out with of the profitability of Cornerstone Place. And that's enough to fund 425 nurses, 200 firefighters, 200 police, and 245 social workers.
Wow.
And that's out with of the economics. And that's all based on independent PwC analysis. It costs over 27,000 for a homeless person to be on the streets each year. So it creates a huge amount of reward and impact But again, you've got to understand what your structure is, what your targets are, what your mission is, what you're trying to achieve, and work with the very best talent you can. Get the guidance. Somebody somewhere has unlocked the value before. Very few of us are operating in virgin territory. So reach out, get some great caliber experience, get a non-exec or a mentor, or joint venture with somebody who knows what they're doing, and go faster together.
Fantastic impact. That's amazing.
It is. I mean, and we opened our latest homeless hostel in Manchester recently, and to meet a couple of the residents, I mean, the stories, I was pretty close to tears, to be honest.
Wow.
It's easy to get locked up in the numbers, but actually this is people's lives. This is children. This is mums and dads who want to contribute back to society, who've fallen on hard times. Very, very moving indeed.
Just a quick one on that then, I guess, is, do you find it difficult to make them commercially stack up from that point, or are you acknowledging that maybe you're sort of, this isn't about a return, a financial return, but this is just about a sort of return back to society, as it were? So, are you, could you have, the property in Manchester, for example, could that have been a buy to let, or could that have been, a conversion to sell on? But you're choosing to put that into Cornerstone Place and have a more of a social impact, or?
So I'm very clear. Cornerstone Place and all of our businesses must be profitable to be sustainable. Mm-hmm. I don't back away from the word profit at all. We're not making profit out of homelessness. We're creating a massive solution to provide, or a massive solution to those deep, non-addressed problems in society. And we make a profit, absolutely. Now, we've had to be very innovative, and there's a lot of IP around our funding structures. A traditional first charge development funder and second charge private investors just doesn't work. This is long-term returns here. So we had to go to different sectors, create different levels of social impact funding. And our ambition is to become a social impact funder ourselves in the not too distant future. So, watch this space, exciting times. And the caliber of the directors in the business who have worked in sustainability sectors and social impact areas and have been affected by, these very, very deep problems in society themselves. So, this is a very powerful business at many levels. So we've got a lot of potential there. So, I'm going to ask that question: which property strategy, and why would you have that property strategy? Do you want to do service accommodation? Do you want to do buy-to-lets, commercial to resi, HMOs, rent to rent? And why are you making those decisions? Strategic acquisition of assets is hugely important. So let me just navigate you through. This is a true story of a gentleman that I met a year ago, earning £200,000 a year. Okay. Only first world problems in his life, and deciding to take life to the next level out of the day job, and was thinking, I'd like to do HMOs. And we analysed this strategically because I was mentoring him. And this is the type of thought process. Okay, if you're earning £200,000 a year, you're going to be paying not far off six figures in tax, £85,000 to £100,000 in tax. That's the Houston I've got a problem moment. Now, the two certainties in life, death and taxes. Don't let anybody ever tell you that. Death, I can live with that one, but not taxes, okay? There are different ways to alter this. And if I'd known this one nugget for 25 years of my corporate life would have been very different, I can assure you now. if you acquire commercial property, you can gain capital allowances. And I'm sure that subject has maybe been touched on a few times. So we've got this lady here who's paying, either she's got a very profitable business and paying corporation tax, or she's got a great day job and paying income tax, but doesn't know that that's a choice. If she acquires this commercial property and puts it in an LLP and claims capital allowances, assuming they're available, she'll be able to offset the capital allowances against her income tax. Likewise, she'll be able to offset capital allowances if she acquires it in a limited company and offset corporation tax. So the choice of structuring, whether you, still the same building, whether you acquire that building in a LLP or a limited company, will have a very different effect on the amount of tax offset. If you bought that same commercial building in your SAS, you'd get 0. A SAS is a very tax efficient wrapper anyway, and you can't claim capital allowances on an asset in your SAS. So you can see structuring gives a very different level of return just on how you structure something. What we can do, of course, is we could acquire a commercial property in an LLP or a limited company. We could draw down the capital allowances over time using sideways loss relief and various things. And then we could transfer the asset into our SAS once the capital allowances have been drawn down. And there it resides forever and a day in a very tax efficient environment. That way you can get the capital growth there. The cash flow is tax free. We've got a pile of assets in our SAS with no leverage on, and we don't really want to put any leverage on now until we find the next property we might acquire, because we're getting gross returns. Why get leverage if you then haven't got anything else to invest in? You know, you're just creating an artificial cost base. So using this model, you create that low cost of funds, increase speed, a vast array of opportunity, and the freedom of choice and control. So starting from, I want to do HMOs because I think I can get some cash flow, to acquiring a commercial asset, which gets cash flow, but could probably save somewhere in the region of £70,000 to £80,000 a year. And it's a rinse and repeat model, because the hardest one is doing it the first year. What do you do with the PAYE rebate at the end of the year? Well, maybe you put that as a deposit for the next commercial unit. That's year 2 and year 3 and year 4. Doesn't have to be difficult. So I ask that question again to each and every one of you. Which asset class makes your car go faster? Is it what you want to do? Because you won't get this with rent to rent. You know, what type of strategy are you looking for? What's right for you? Nothing wrong with it, all these asset classes. It's just deciding what is right for you and not following other people like lemmings. Now, I love this.
Mark, just quickly on that then, I guess capital allowances, you know, I guess for people out there who maybe aren't familiar with capital allowances and that sort of side of things, like always, you know, maybe a few examples or the sort of level of capital allowances versus the sort of value of a building, you know, that sort of side of things.
Yeah, I mean, it's an entire subject in its own right, but capital allowances, a surveyor will measure the plant and machinery in the building. That could be everything from fire doors, trunking, light fittings, air conditioning, external lighting, you know, switch gear, that kind of thing. Can only be on commercial property. So if you've got standby generators and UPS systems, that sort of thing, fantastic. And you can, that's a value that you're acquiring, and you can offset the value of that. Now, let's say that's worth £100,000. If you acquire it in an LLP and you're earning the kind of money my friend is, you'd probably get 45% of that off your tax bill. If you acquire it in a limited company, you get 19% this year. It's going up to 24, 25%, isn't it? But so you can see, just by housing the same property with the same capital allowances in a different structure, you'll get a different tax offset off your bill. So yeah, there's a whole, I could do a day on this subject and probably will actually, but yes, super critical to understand what value. Now, not every commercial building has got capital allowances, so you need to make sure you've got that tenacity in how you structure the offer, and just have a fantastic team and great guidance and support to enable you to liberate the right strategy for you. And if you can unlock that, you can get triple the returns, cash flow, forcing appreciation, adding value, and tax offsets as well.
Fantastic. And one just quick question as well. So just to sort of clarify then, was the SAS buy the property from the limited liability partnership, the LLP? Is that what was happening at the end there when you're saying protect with your SAS?
Yes, it can do. Yeah. I mean, you may choose to just leave it in the LLP and just add more properties to it, each one having more capital allowances, and just keep going. But you've also got to think of your funding as well. Think of your senior debt funding line. You know, is it the most tax efficient? Is it the optimum level, the lowest weighted average cost of capital to get it through an LLP or a limited company, which you can get pretty vanilla long-term bank finance, or through a SAS. And we're seeing with SAS is different gearing levels and different appetites there because of different security structures. So it really does depend, and everybody's circumstances are different here. But you can see the model would lead you probably actually not to do HMOs in this occasion, because I can get a whole lot faster, quicker. And if I'm buying this commercial property here for the capital allowances, imagine if that's got 3 years of a 15-year full repair and insure lease left on it. Well, in 3 years, could I take an option on that property in a limited company? I could take an option with my SAS on that property. I could use my SAS funds to go through planning, spend 10, 20, 30,000 on planning, and then depending on the assignability structure in the planning, in the option, then I can decide where that building best resides. Do I exercise the option and buy it in the SAS? Do I assign it to a special purpose vehicle and develop it and sell? Again, you can see how it depends on your strategy, but you're giving yourself a much wider peripheral vision of the options that are right for you. And I'm going to say again, unless they're compliance and governance issues, there's no right and wrong here. These are all lateral thinking exploits that you can, test and, kick the tires on to make sure which one's right for you. Our accountant, Chris Smith, comes up with a great quote every now and again. You must pay taxes, but there's no law that says you have to leave a tip. And again, if I'd known this 25 years in corporate life and the amount of tax I used to be paying and have driven leverage into that, super incredible. There's a one-day introduction to property development. So if you're enjoying what we're talking about this evening, Thursday, the 30th of June in the De Vere East Midlands Conference Centre in Nottingham, then go to our website, equaacademy.co.uk. I'll put a link in a bit. There we go. 49 quid. Just help us cover the cost of some butties in the room. And we'd love to get to know you and come and spend the day with Nigel and I. Almost full there. Now, we said we'd talk briefly, and Andrew, I'm conscious of time, so 5 more minutes, and we'll just cover the promise model.
Yeah.
This is about raising private capital. You need a clear process. You need to understand the type of returns that you're prepared to deliver, having the right structure to put the right options together, whether that's debt or equity. I'm not talking about lease options here. Having the right economic model, the model that serves you. You're more important than anybody else at the moment because your investors aren't on board. Once your investors are on board, you'll walk 1,000 miles over broken glass to make sure they're happy and content. But at this point, the model has to serve you, and it has to be attractive enough to as many investors as you require for your strategy. You need to be investable, and I teach people how to become investable and credible. What's the security package required? What's the level of engagement that you have with investors, not just before, during, but also after and subsequent? Then creating that draw towards you at a level that you get the right volume for you. And if you achieve that and have the fundamentals of looking at the multiple returns, the return of investment, this is ROI to the power of 6, return of investment, return on investment, return on intellect, because we run an earn and learn. So people are learning as well, walking a mile in our shoes. The return of social impact, which we talked about, the cornerstone place, return of interaction. So they're meeting fellow investors, SaaS trustees, and developers of the future. And that return on inspiration as well. Now, we are tight on time, but holding company structures, special purpose vehicles, again, using sideways loss relief and dividends, tax efficiency. This is right in the heartland of having a great accountant stroke great tax advisor. And you can modulate this. This directly links with how you structure businesses, but also how you also structure your private investment fundraising. I've raised over 35 million in the last 5 years of private investor capital. So I know how to do this. I know what works, what doesn't, the compliance, and also the interaction you need to have with everyone from your bank, as in your banking facility, to your development finance, who need to very much approve this with AML, KYC, and checks. Of course, we've got all the governance required on fundraising as well, which is super important. And remember, what are you actually buying? A number of our recent acquisitions, we've actually bought the business rather than the property. So we bought the company. Almost always it's a special purpose vehicle with no trading history or track record, apart from a developer bought a piece of land, got planning, and rather than buy the property and pay 5% stamp duty, we can buy the business and pay 0.5% stamp duty, because we know how to structure these deals. Now, I do just want to put a health warning on that you will be doing a lot more due diligence there, but something that you need to just bear in mind. So your legal fees will be higher, but you can save an awful lot in stamp duty. Lots of company structures, and how you can modulate and protect yourself, create risk management. This is one of our latest investment opportunities, and we're just securing this at the moment. It's a new build in Battersea, and we're de-risking this by pre-selling many of the units. And you can look at that too by walking a mile in the investor's shoes and the bank's shoes. Look at what their primary risks are. Their primary risks they will see in you is it going to cost more to build? Is it going to take longer to build? And will the GDV suffer? And if you can pre-sell those units, you've taken away a massive headache from them, and they'll probably drop the funding rates because of that as well. So there's an example of a new build one that we're about to do. And there are any number of ways of structuring deals. Here's some. I won't bore you with the detail at the moment, but we'll cover this on the one day in Nottingham. Different structures from about 600,000 through to 19 million GDV. Horses for courses, different types of structures appealing to debt investors, equity investors. All these are now, or 3 out of 4 of those are all complete now. And I'll leave you with this one thought. There is no heavier burden than an unfulfilled potential. by Mr. Charles Schulz. There's George Russell climbing out of his wrecked Williams last year at Imola, I think it was, after a collision with Valtteri Bottas. Let's not have any one of us, looking back thinking, I could have been better, I should have been better. There's always room for improvement, and surround yourself with great people who challenge tradition, who live on the conservative side of life as well, and really drive this through with good compliance and governance, and you'll be amazed at the compounding growth that you can achieve. There we go, Andrew. Hopefully that added some value and ticked some of the boxes for the people out there.
Yes, indeed. Thank you. I think, I think this is definitely one to sort of to try and come back and sort of listen to and sort of go over again and all of that kind of side of things, because I think there was, like I said, there was so much in there, but, like I said, there's probably more to think about around how to, get maybe your pension into a SaaS and start utilizing that and leveraging that within some of the work that you're doing. But also, again, I think some of the other sort of key points around there, just being able to just, think about that longer term, like how are you going to structure yourself now so that it works in the longer term, and like you say, not tipping the tax man where you can, and like you say, just paying where it's necessary and only that. And so I think definitely one to sort of keep sort of checking back to. I am conscious of time, which, like I say, we sort of allocated sort of an hour and a half for this, but I'll do a quick flick through Nimbus Maps. Fundamentally, like I say, today's session is about understanding how you can structure yourself to be a success, but the fundamental parts of that are being able to find those properties in the first place, and that's where hopefully Nimbus Maps can come in and help you out to find those properties. And then what we'll do after a quick demonstration is then we'll open it up to a Q&A. I'll throw all the questions to Mark. I can see there's a few people in there, but do throw any more questions into the chat or into the Q&A, and we'll sort of run through all of those before we finish up today. So you'll see here, I'm sharing my screen. This is Nimbus Maps. Fundamentally, it is Google Maps, but with all those extra layers on top, and enabling you to find those opportunities. So if I just pick a location here as Aylesbury, we can scroll in a bit further, and you'll see all of that ownership layer now comes up over the top on the map. All of these white boxes are different freeholders. If you want to see the leaseholders, then we can obviously toggle those on as well. And now it's about, we know where those owners are. We now just want to see where are the ones that meet your strategy. So like I say, following a bit of Mark's advice there around sitting down, what is your strategy? Which one works for you from an enjoyment point of view, from a returns point of view? Is it driving cash flow? Is it driving net wealth? Or we can help you find those through the filters. If you want to find commercial space, say office space, you can simply set the filters, and rather than seeing everything, we can now just see that sort of office space within our view. And not only that, obviously funding is a key part of it. What can you actually fund? There's no point thinking, we're going to fund some massive 50,000 foot, X sort of sort of head office. We want something that's more reasonable in size, and then we can obviously put size filters on there. So now we can then really pick out, where is that particular property which is going to make a difference. By clicking on one of those properties, you bring up this information panel that allows you to see what is going on that specific property. So in this, we can see it's all office space. We can see the owner is LKH Properties Arden Court Limited. This is Arden Court. So unsurprisingly, this looks like some sort of SPV just to own this particular property. They bought it back in 2020. And we can obviously look up their details through Companies House, should we wish. Not only that, we get the other information around this property. How big is it? What's the sort of footprint? What's the height of it? We can look at all of those details at a very quick glance. We can see a breakdown of those, the existing value in that commercial property as well. Ultimately, we've got a second floor office, ground floor office, first floor, bits of other bits on the ground floor there as well, a bit more office, and we can see where all that value resides. So Sealy, this third floor office paying quite a lot in rateable value. That's clearly the one to the high value one, although there's a bit on the ground floor as well. But if you're looking maybe for those commercial conversions, sort of shops with uppers, that sort of side of things, where is that low value? This is a great tool to help you find that. Obviously, what are they paying for it? Both from a comparables point of view, are you overpaying for that property? Or from just a negotiation point of view, if they bought it for 1.2 million in 2020, the last thing you want to do is start saying, would you be interested in selling it for $1 million? Unless the fundamentals of the market have switched, then it's very difficult, psychologically very difficult for them to sell at less than what they've bought it for. And then we've got things like, actually, it's in this property, or part of this property is actually on the market. So now, we can click onto here, and there we go. There's that Ardenham Court, Oxford Road, Aylesbury. And we can actually then go and contact an agent about that particular property. What it also does is highlight the fact that, they're not getting as much of an income from this property as maybe they were intending to. Does that put a bit more pressure on them? Are they potentially thinking, I might offload this, and then it's a longer term play with maybe some of the existing tenants in place? Obviously, remembering that we can put that lease on where we applied the filters, so it's not showing, but apply the leases and make sure there's no leases on there as well. Then we may want to consider things like planning. Is there any planning permissions or applications being submitted on that property? We can see that by just checking this little box here. And to be honest, there's nothing coming up. So again, there's no planning permissions there. And then are we going to come across any sort of key constraints on this particular property? Is it listed? Is it in a flood zone, or is it in a green belt? So again, just nice and easy, very quick, what kind of constraints we're going to come across if we were to redevelop this into residential. We also, on that right-hand side, are able to pull together some, high level, macro level information as well. Things like what are values in an area. We can see we're in a £300 a square foot area, or yields. If you're using this as a buy to let, what kind of yield would we expect to get? So you can start plugging those in. If you're trying to just maybe make a quick assessment, well, if we did, pursue buy to sell, what does that look like from that appraisal? Maybe when you're filling in your sort of strategy chart and working out what's best for you. These are great little headline tools just to sort of show you where you want to be and what's going to work for you in what area. And again, you've got this sort of deprived area index, which then factors in basically where are the desirable parts of a town and where are the less desirable parts. And we can obviously see, the outskirts seem to be better in this location. For anyone who is doing HMOs, and maybe Mark's just changed a few people's minds on HMOs, certainly from a financing point of view and certainly a tax saving point of view. But if it is HMOs, then where are those existing HMOs, and therefore, where is the demand and where isn't there? We can obviously show you all of those, and we'll even give you all the information against those as well. And so on and so forth. But some other key aspects here as well is your planning. So all the access to your planning information, whether you want to check nearby applications, or we want to do a search for applications. So if we're in, I'll pick South Oxfordshire. No, we're not in South Oxfordshire. But I'm not quite sure which county Aylesbury's in. So South Oxfordshire, if we want to find office conversion schemes, then we can do so. If we want to find them up to 50 units, then we could do that as well. And we can bring all that information into an Excel file, allowing us to work through and find those relevant, essentially planning applications. And this is live, it gets updated every 24 hours. So ultimately, if you are looking for a site with planning, in terms of de-risking the planning, then you can obviously find that here. So you can see there's a change of use from B1A to 8 dwellings. That was actually refused at the 19th of this year. So again, that might be one to have a look at. Why was there reasons for refusal? Because interestingly, that planning application was B1A to Resi. That's now a PD right. So, you know, maybe there's an opportunity to go back in on that one. You know, where was it? Linked to where it is on the map, then who owns it? So again, if you're looking for those JV partners, who else is active in the area? Maybe you're going to get to planning yourself and you're looking for people who you could sell on to. This is a great way of then finding those active developers within that location, enabling you to then reach out and try and sell directly rather than having to bring in a third party to act on your behalf. Or what are other people paying for property? We can obviously apply that there as well and see what other sort of values people are paying. Or, you know, like Mark said as well about, you know, making sure you've got good quality professional team behind you. If planning isn't your expertise, then let's help you find a planning agent. And you can see these are all the planning agents for all the residential, well, office to residential conversions in South Oxfordshire. And so we can pick out the various people in here, maybe putting some filters on there so you can see which ones are the most popular, will then help you to find that out. Really, really handy tools. And the last one I probably just want to sort of highlight here as well is then those specific comparables. So if we are looking to convert, you know, to a bunch of flats, we could then obviously look at what are flats actually selling for in this location over the last 18 months. We can now see on average, it's coming out at £251 a square foot. Or if we want to look at it in pound notes, we can see that's roughly 200, well, between about 150 to sort of 200 seems to be the sort of average of a flat in that location. And again, super quick appraisal. We now know roughly what is likely to be the returns that we can offer our investors or back into yourself through your SaaS pension as well. So if you are interested in finding out a bit more about Nimbus Maps and how it can help you find more properties, then do use this QR scanner here. Scan this page, it will take you through. You can book a call with the team. They'll talk you through it. They'll show you how it works for you. Like I say, we have people who are doing HMOs, commercial conversions, new build resi, commercial property, just commercial developments, you know, drive-throughs, energy developments, all of that kind of stuff is all people are using it to help find and assess those opportunities and connect with the relevant people. So do scan that and book your call. Likewise, if you do want to take Mark up on his offer there, you've got the links or the QR codes there to connect with Mark and obviously book onto that session in Nottingham, which you mentioned earlier today as well, which gives us not a huge amount of time, but to be honest, you know, we can run through as many questions as we can before then hopefully we have to all leave this evening and enjoy our evenings. But I can see a few questions coming through now. And Amien says, a question for the end of the session. So they were nice and early off the mark with this one, but we probably touched on it a little bit towards the end of Mark's presentation. But as a new developer looking to incorporate company, what company structure would you recommend? Is it a holding company with SPVs for each development? Your thoughts, Mark?
Yeah, it's a great question, and there isn't a simple answer, I'm afraid, because it depends on the scale of the size of the development. There are some development funders out there who won't fund holding company structures. Most will, I have to say. Precise are an example of one that generally won't. So looking at whether it's a development, buy, develop, sell, or buy, develop, hold, working with your broker, working with your accountant. But yeah, I think a holding company and SPVs underneath them will give you an awful lot of flexibility and cover most scenarios. But equally, you're also going to want to be looking at the private investor structure as well, debt, equity, what level of security you give them. Make sure you impart that information to your finance broker as well to give them the best chance of bringing the best funding to suit. So it's a combination of all those things, Amien, and hopefully that's helpful. But yeah, I think you're on the right lines there.
Fantastic. The next one's with Anthony, which otherwise asking for a friend or himself here, but what would you suggest for someone sitting on 2 million in cash, likes property investment, but does not want to carry out building work? I suppose, again, that's quite an open question, which might lead to lots of answers, but I don't know whether you want to have a...
Well, I think it's a really interesting point, particularly where we are in the market at the moment. We've got, hyperinflation going on, interest rates moving. I've worked in the construction industry for 25 years. And if your friend is, acutely aware of some of the volatility and performance issues in the construction industry, then he's on the same wavelength as me as well. In fact, we've got our own build company to do large scale construction, the multi-million-pound schemes, because we wanted to just take that sensitivity away from the rest of the construction industry. And it's quite difficult to predict some of those build costs. So what would I do? It's all going to depend on the risk and reward appetite. I do have lots of these calls with people who want that guidance and support to get the right clarity and strategy for them. Acquiring finished assets, with that level of cash pile, how you can then diversify, complete build assets. You'll be the biggest friend to many developers if you look at pre-purchasing. At today's market value for an asset that's probably going to come on the market in 12, 15 months' time, you can get substantial discounts to market, particularly if you're a funder as well. So you get the return on equity or return on debt that you might bring, decent levels of security, and depending on scale, you might even get a first charge security with that level, without imparting too much concentration risk. But Anthony, if you want to book a call or drop me a line, happy to chew those over. As with anybody who's got any questions, just book a call with that link.
Fantastic. And then Shamir, are there other points to note if I were to be the sole trustee of my SaaS? I think, is that right? I don't know whether you can do that. I think, is that not what the point?
Yeah, you could be you can have a solo SaaS and be the only member trustee. It's understanding what support you want. So you probably have a corporate trustee there, unless you really want to go it alone, which I personally didn't. But you wouldn't be able to do an general unallocated fund, a GUF, with a sole trustee.
That's what I was thinking.
If you have multiple trustees, your decisions are joint and severally liable. So in effect, everybody has a veto as well. So you need to come to the same decision making. So if you've linked pinkies with your newfound mate at the latest sort of networking meeting and decide to set up a SaaS together, I'm not sure that qualifies as a real deep thinking and long-term decision making on a SaaS. So the reason why Nigel and his wife and myself and my wife were the four trustees of our SaaS is, look, we've known each other for 24 years. We know each other inside out, back to front. We've got similar levels of risk appetite and similar levels of wealth to really make that palatable. But there also comes a point where you're thinking long-term as well, where you may have children, you may want to bring children on board in due course, but then the kids have a different level of risk appetite. I'm in my early 50s. The kids who are 18 or 20 might have a different, a bit more racier appetite to risk. So you can be a trustee of more than one SaaS. So that's what I'd probably do there, is set up a second SaaS, and I'd probably be a trustee with them on their SaaS. So just, and I cover quite a lot of these things in my books as well. So you can just research some ideas there.
Fantastic. From Anonymous, thank you for a great presentation. Is it a must to use a specialist accountant and tax advisor to run my property development business, or could I use a subscription-based accountancy platform that provides generic accountancy support to satisfy minimum legal requirements? Former option, obviously more expensive compared to the latter.
Well, we're underpinned by great advice and support. I don't think you would get, $1 million professional indemnity insurance on a subscription-based service. When you've got accountability and responsibility to the banks, to investors, if you're offering investors equity or a profit share return, then you need an accountant who can run an independent reconciliation of the balance sheet and profit and loss at the end of the development. And I think it's more the way you work. I like to surround myself with fantastic people, and we're operating at a great scale. And I certainly wouldn't nickel and dime anything in accountancy, tax advice and structuring. Just my view. But if you're doing smaller developments, you may still need some specialist advice, but you may have a partner who is an accountant. Lots of different angles to that, but don't nickel and dime great advice. It will cost you in the long term if you do, would be my advice.
Yeah. Fantastic. And then we've got Chintna saying, hi Mark, I can't make the 30th of June. Is there another date later on?
Just drop me a line, and if anybody wants to either book a call, drop me a line. We've got the Equa Hub going live at the end of June, so lots of opportunity there to join in our community, and we do lots of learning like this. So find me on Facebook, just drop me a message.
Fantastic. And I think probably related to that one, it probably relates to that one. Can the session be reached online or Zoom? As I'm in West Wales, about to fall into the sea. I hope you're on safe footing there. But I guess is there a Zoom version to connect, or is it? I guess
there isn't for that day, but the Equa Hub that we're launching at the end of June, so only a couple of weeks' time, has got a 7-week developers program all recorded online, lots of content. So we'll be releasing details of that. So just stay close, join us in the Property Developers and Investors Facebook group, and we'll be announcing that. But if you follow me, you'll hear about that in the next 10 days, 2 weeks.
Fantastic, which I think covers all the questions, which fun enough leaves us only a few minutes over the allotted time. So I appreciate everyone's time for sticking with us, which only leads me to say thank you very much for Mark. Fantastic presentation, huge amounts of content in there. To be honest, even I think for myself, I think I'm going to go back and start doing a bit of audit on my strategy and everything. But hopefully some fantastic stuff there. So really appreciate your time today, Mark.
My absolute pleasure. Thank you for inviting me, and hopefully it's added value to lots of people. And I've just put my email address in the chat box as somebody suggested.
Fantastic. Oh, you're very brave, Mark. I think there's, people get inundated with messages off the back of these. So yes, obviously I'll delay a second so people can see that in the chat should they wish, but mark.stokes@equasas.co.uk. And thank you to everyone else. Thank you for all of our fantastic viewers today. We've got a great audience, and hopefully you've all found something interesting. There is a quick, a few questions just as you close the session today. It'd be great to have your feedback, and so we can bring more fantastic presentations, or we can learn and hopefully improve for the next time as well. So have a fantastic evening, everyone, and we'll see you all next time. Thank you.
Thanks Andrew. Appreciate that. Bye-bye.
Bye now.